Welcome to another webinar session hosted by ArgusFX. Today's webinar session is more of a theoretical, let's say, together with some graphical illustrations of the candlesticks on the charts. The basic idea of today's webinar session is to identify and to be able to differentiate bullish and bearish bars. In other words, to identify an uptrend bar or a downtrend bar. And one type of a candlestick bar that can somehow inform you beforehand about where the price will move next. Just to start with our standard slide at the very beginning. As you all know, our today's host is ArgusFX. ArgusFX is an STPCN broker, and an STPCN broker is one that benefits from trading volume. In other words, the more volume traders place on their orders, the bigger the commission for ArgusFX. And this is fair enough. And in other words, it's a win-win situation with the client or the trader. Some of the many benefits which ArgusFX offers is, as the majority of you know, the MT4 platform, protection, regulation, very good spreads, no charge on deposits and withdrawals, instant funding and withdrawal, which is a very important parameter, multilingual support in other words in different languages, expertise, coaching, financial updates, and one of the most important parameters, security of funds. As long as you know that your funds are secure, then you can trade with more confidence and feel this interconnection with your broker. The conclusion is that an STPCN broker is the very first step to a fair trading activity. Let's move on to the topics that we are going to talk about today. As you all know, in economics, we have the law of demand, the law of supply. Therefore, we are going to see how these two laws are applied on the platforms in the sense of bullish bars and bearish bars. Then the fifth topic that we're going to look at is the key candlestick bar. This is a type of a bar that can somehow inform you beforehand what the trend or where the price will move next. And the last point, it's what do we need to understand at the end of this webinar session, and what are the major points that we should capture, which is the major spice of our today's webinar topic. Okay, the law of demand. As the majority of people already know through economics, when the price of a product or service rises, the quantity demanded will drop. Because if the product price is very high, the demand for that product will drop. Because it's going to be so high the price that the buyers will not be that interested to buy that product or service. On the other hand, when the price of a product or service drops, the quantity demanded will increase. So in other words, when the price of a good drops, there's going to be many buyers interested to buy the product or the service. Therefore, similarly in Forex, when the price of a currency pair drops, the buyers are willing to buy. in order to benefit from the lower price and make a profit at some point in time. When there is a high demand for a currency pair, the buyers, they place their buy orders. Therefore, the law of demand, in general terms, describes that buyers always aim to buy low. So all the buyers, even in Forex or in our everyday life, they always want to buy products or services at the lowest price possible. So it's exactly the same thing with currency pairs. Buyers wait when the price of a currency pair drops so that they can buy at the lowest, best possible price. On the other hand, we have the law of supply. When the price of a product or service rises, the quantities applied at some point will increase because the suppliers, they want to sell at higher prices to make more profit. Alternatively, when the price of a product or service drops, the quantities applied will diminish. In other words, when the product or service can be sold at lower price, the suppliers will not be interested to sell because in the most of the cases, they will make a very small profit. In Forex, when the price of a currency pair rises, the sellers are willing to sell. So they expect when a currency pair hypothetically reaches a very high level, and then to sell that currency pair to make a profit. Therefore, when there is a high supply for a currency pair, the sellers place their sell orders. In other words, the law of supply tells us that sellers aim to sell high, because the higher they sell a product, the more they will make at the end of the day. So the law of demand illustrates that buyers want to buy low and take advantage of an uprise of a currency pair, whereas in the case of the law of supply, the sellers aim to sell high to make a profit through a downside move of a currency pair. Let's see now what do we mean by bullish and bearish bars, and then we're going to see an illustration on the charts. So a bullish bar is, let's say, the situation where buyers are greater in volume than sellers. In other words, we have the so-called excess demand. Demand is greater than supply in the scenario of a bullish bar. Therefore, when we have a bullish bar, the base currency strengthens. In other words, if we have the euro dollar and we have a bullish bar, it means that at that point in time, the euro strengthened against the US dollar, which is the counter currency. When we have a bullish bar, we have the so-called bullish or uptrend volatility, movement in other words. Therefore, a bullish bar is one where the price opens low and closes high. Therefore, we have an uptrend momentum, an uptrend volatility, which the bullish bar describes. Let's see the other side of a bearish bar. The situation of a bearish bar is one where the sellers are greater in volume than the buyers. It means that the sellers are by far more than the buyers, therefore exerting a bearish momentum, a momentum to the downside. And we have the so-called excess supply, which means that supply is greater than demand. In this case, when we are talking about a currency pair, the base currency weakens, whereas the counter currency strengthens. In other words, we have the euro dollar. Therefore, in the case of a bearish bar, the euro loses value versus the dollar. It weakens because there is volatility to the downside. Therefore, a bearish bar is one where the price opens high and closes low. Therefore, is the exact opposite of a bullish bar. A bullish bar opens low and closes high, indicating an uptrend volatility, an uptrend movement, whereas in the case of a bearish bar, the price opens high, closes low, an indication that we have a bearish or a downtrend volatility. Let's see now this slide and take one by one the charts we see here. Let's see the very first chart. This is an example of a bullish bar. You can see that the price has escalated from this price level to this price level. Therefore, we have a bullish candlestick or an uptrend bar. On the other hand, here we can see a bearish bar, where the bar opened high and closed low. Bearish candlestick or downtrend bar. Let's move on to the other chart we have. Let's analyze this bearish bar. As we said previously, a bearish bar opens high and closes low. So in this case, at this point, we have the opening price. The price came lower, 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 and closed at this point, prior to the opening of the next bar. Throughout this movement, throughout this downtrend movement, we have also noticed the highest price and the lowest price. So as you can see, a bearish bar, like a bullish bar, has a high opening price, a low closing price, the highest price reached at that point in time, which it was a 1 hour bar, and the lowest price at that 1 hour. Furthermore, we have the alternative case of a bullish bar. As you can see, this bullish bar opened low at this price level and closed high at this price level. Throughout this 1 hour movement, this candlestick bar, since it was a bearish, faced its highest price at this level and its lowest price at this level. In other words, both bullish and bearish bars have 4 features: an opening, a closing, the highest and the lowest price levels. So similarly, for all other candlestick bars, you can see there are different formations, but never forget that every bar has these 4 features: opening, closing, lowest and highest price. Let's see now a very important candlestick bar. As you all know, if you search on the internet, you are going to see plenty of candlestick bar formations, dojis, other types of patterns which describe how to identify a hypothetical price movement, and all this confusion which the internet creates, and many gurus which, by their mistake or accidentally, they tend to confuse people. If you're going to use as part of your strategy or analysis candlestick bars, which candlestick bars is an interpretation of price action, then in my opinion, the type of bar that will make the difference to your strategy and your analysis is the pin bar. The pin bar is by far the most powerful candlestick bar formation for price action. But let's take this slide from the very beginning. An important note which we have already emphasized from the beginning and on the previous slide is that each candlestick bar has four features: the opening, the closing, the high and the low price, which these features, they interpret the movement for each candlestick bar depending on the time frame of your choice. So if you have on the chart an M30 time frame, every candlestick bar will record these four features for a period of 30 minutes and so on, for an H1, M15, and so on. Now let's move on to this specific key candlestick bar, the pin bar, that surely helps a trader to identify whether the price will rise or fall. Sorry for my mistake there, it's supposed to be an or. Let's see now an example of a pin bar, two pin bar formations. Let's read this first. A pin bar is a candle that has a shallow body with long wicks. Long wicks is this, let's say, candle type of tail to either the upside or the downside. So let's see a bearish pin bar. In this case, this candlestick represents a bearish pin bar. Why? Because it has a high tail and a low nose. On the other hand, the bullish pin bar has a low tail and a high nose. So you can see that in the case of the bearish pin bar is like an indication that the next candlestick bar will be a bearish one because there is a strong momentum, strong forces to the downside. On the other hand, the bullish pin bar shows that the next bar or the next movement will likely be a strong bullish bar. So in here there is an indication that the price will drop to the downside upon the opening of the next bar, and here it's an indication that upon the opening of the next bar the price will move upwards. So you can see the pin bar, this type of candlestick bar, illustrates specifically and very clearly where the price will move next. So using this type of bar, either a bearish pin bar or a bullish pin bar, will help you to identify or predict, let's say, or speculate where a financial instrument will move next. So you can see it's very, very clear and very pretty, this formation here, or this formation here. The majority of traders, they use all different types of candlestick bars, patterns. They complicate the situations, and at the end of the day, it's a mess. Therefore, as we have already said in previous webinars, you have to keep things simple. The more simple a strategy is, but a strategy should not be super simpler. You cannot place, let's say, your whole strategy only on these pin bars and say, every time there is a bearish pin bar, I will sell. Every time there is a bullish pin bar, I will buy. If you try to do this, you are finished. Do not base your strategy only on one criteria. Use a combination. So, a pin bar should be part of your strategy, a very important part of your strategy, but not your whole strategy. But by mixing this type of candlestick bar to your strategy, you will increase your probabilities of placing the right trade. Okay, so let's see the points to remember. These points may sound or look simple, but this should be the major idea of today's webinar session. Bullish bars. Bullish bars, they open low and close high. Bearish bars, they open high and close low. What do we mean by excess demand? Excess demand, it means that buyers are greater than the sellers in trading volume. Excess supply. Sellers are by far greater than the buyers, again, in trading volume. And let's see again the bullish bar. A bullish bar is created when the quantity demanded for a currency pair or any financial instrument is greater than the quantity supplied. In other words, the buyers are greater or more than the sellers. In the case of a bearish bar, the quantity supplied is greater than the quantity demanded because we have more sellers trading than the buyers. And what we have, let's say, talked at the very last slide of this webinar, a major reversal bar is the key candlestick bar called the pin bar. So you imagine the pin bar as a needle. So we have a bearish needle and a bullish needle. The bearish needle indicates that the price has greater probabilities to drop, whereas the bullish needle, the bullish pin bar, indicates that the next candlestick bars will likely be bullish ones. You see, there are also traders which, and it's not a wrong way, they solely base their strategy on price action. Pure price action strategies depend solely on candlestick bars. But as we already have said before, try to keep things simple in sense of interpreting the candlestick bars. In my opinion, the pin bar is a powerful candlestick bar, and the simpler type of bar which you can identify from all this chaos of bars which appear on the chart. Because many gurus, many traders, many, let's say, investors, they try to interpret all different types of candlestick bars. And at the end of the day, they either act very wrong, they place the wrong trade, or they interpret what they see the wrong way. Therefore, by keeping things simple in terms of candlestick bars, you will maximize your probabilities for success. Let's see now. We have questions. Let's see. I hope things were clear. Do we have any questions? Something which it was not very clear, or something which you need better clarification? Feel free to ask without any issue. We are here to support. Okay, so what we try to capture out of this webinar is some basic understanding, but a very powerful basic understanding of the candlestick bars. You see, the law of demand and law of supply applies everywhere. Actually, these two laws are the ones which guide our everyday life. Whatever we do, there is a supply and a demand. So things keep moving either in the business sector, in our personal lives. We are guided by the law of demand and the law of supply. Therefore, economics is not just a finance topic, but is more of a personal topic at the end of the day. And what more, that these laws apply in Forex as well. So in Forex, what you are trying to identify is whether the upcoming bars will represent a bullish or an uptrend movement, or the upcoming bars will illustrate a bearish or a downtrend movement. You see, everything is on the chart. What goes up goes down. So the simplest way to interpret these uptrend and downtrend movements solely depends on the candlestick bars on the chart. So if you are able to include in your strategy, which actually you are not including, you are just, while watching the chart, you have your strategy, and many of you which they have watched the trading like a pro, the basics to know, we have illustrated there a very powerful strategy, an excellent strategy that when applied the right way with patience and discipline, then you will maximize your probabilities to success. Therefore, we have a strategy, and if in this strategy we pay also a bit attention on the candlestick bars, like the pin bar which we have illustrated today, then it's like an extra confirmation that your decision to place an order was a high probabilistic one. So let's say you have your strategy, or the strategy which we have shown on some weeks, last weeks, 2 weeks ago, 3 weeks ago, I don't remember exactly. On the Trading Like a Pro webinar, we have shown a strategy there. Therefore, if you use that strategy and you include in that strategy watching the bullish and the bearish pin bars, then it's going to be like an extra confirmation to your strategy. Let's see if we have any. There is some questions. Let me see if we can spot them. Let's see. Do we have any questions? Let's see. I've seen some hands raised here. Okay. Anyway, let's go. We came to the very first slide. Let's go to the last slide. Okay. Okay, so what we were talking about before we close this webinar is if you see a bullish pin bar, which means this type of pin bar. Let's go a bit back. Let's go a bit backwards. Okay. If you see a bullish pin bar within your strategy, and let's say you have decided to buy a currency pair based on your strategy or the strategy which we have shown some weeks ago, and you've decided to place a buy order. If during that time which you have taken the decision to buy, there is also a bullish pin bar appearance, then it's a further confirmation that your buy order will likely be the right one. On the other hand, if based on your strategy or the strategy which we have showed, you've decided to place a sell order, but during that moment you also see that there is a bearish pin bar in place, then this bearish pin bar is a further confirmation that highly likely your sell order was right. So this is an important aspect to mention. So let's go to the final slide. Next Thursday, we are going to see how we can combine this pin bar candlestick bar with a strategy that you can somehow identify whether the upcoming movement is an uptrend or a downtrend one. So eliminating anxiety and fear. And anxiety, it means like desperation. When usually traders, they want to trade even if they don't see an opportunity. And then once they trade, they started to have a fear because they have hurried to place a trade without thinking, just because they were anxious. And then fear captivates them. And then it's a chaos of feelings and emotions that surround the trader. So our next webinar topic is eliminate anxiety and fear and trade the right way. So we're going to see how do successful traders trade, what they have in mind, what risk and money management criteria they implement, together with the strategy which we have illustrated in last week's webinars, and together to create the best conclusion for trading the markets and particularly the Forex market the right way. I would like to thank you for your time. Hope you enjoyed this webinar. If you have any questions, you can always contact support@argusfx.com, and we're going to be really happy to come back to you with an answer that will make your afternoon a pleasant one. Thank you all for watching today's webinar session. Looking forward to see you all next Thursday.